If you're buying a home or doing a refinance of your existing mortgage, you may be wondering how the whole mortgage process works. Knowing where you are in the process and what the next steps are can be very helpful. Let's begin with step 1, which is submitting an application. You can complete a mortgage application online, in person, or over the phone. Once you've submitted an application, the loan originator will contact you to ask some additional questions. The next step is to see how much you qualify for, which takes us to step 2, qualification. If you're buying a home, the loan originator may give you a pre-qualification or pre-approval letter so that you know how much money you can borrow so you can go out and look at homes. When you refinance an existing mortgage, you may be simply wanting to change the terms of your loan to a lower rate or get a fixed rate mortgage if you're currently in an adjustable rate mortgage, otherwise known as an ARM. Or you may want to take money out, which is called a cash out mortgage. Whatever you want to do, you'll need to know how much you qualify for. Whether you are buying or refinancing, the loan originator will ask you some initial questions like how much you earn, how much you have in savings, how much do you owe on your credit cards, cars, etc. This will help them to find out what programs are available for you and how much you may qualify for. This brings us to the next step, which is submitting your documentation. You will begin by sending in your documentation. This is the information your loan originator will need to qualify you for your loan. They will tell you exactly what they need and make it quite simple for you to give it to them. Once you have given them the initial information that they need, they will then send you paperwork that is called disclosures, which is the next step. Most mortgage companies use a submission checklist to organize the information contained in the loan. Typically, this documentation will include 30 days of your most recent pay stubs, 60 days of your most recent bank statements for all of your accounts, your previous 2 years' tax returns with all schedules and W-2s, a fully executed agreement of sale for purchase loans, and if you're refinancing, a copy of your most recent mortgage statement and homeowner's declaration page. Each borrower is unique and may require different or alternative documentation given their specific situation, so you may be asked to provide additional documentation as the file goes through processing and underwriting. Which brings us to step 4, which is your disclosures. You will receive a set of disclosures from your loan originator. The disclosures are called a loan estimate and will include all of your costs of the loan. The loan estimate is a 3-page disclosure and must be delivered via email, electronically, or in person. Most companies send disclosures electronically through a secure online portal. The loan estimate details the costs associated with the mortgage. There are other disclosures that are required by law to be sent. It is important to review the disclosures and let your loan originator know if you have any questions. You must let the loan originator know if you have received the disclosures and are ready to move forward. This is called an intent to proceed, which is the next step. The intent to proceed is usually completed electronically, which means that you're ready to move ahead in the process to the next step, which is ordering the appraisal. Once you electronically sign the initial paperwork, your home appraisal will be ordered. Some loan types allow for an appraisal waiver, and if you are fortunate to receive this, then you will not need to order an appraisal. The first step in getting your appraisal will be setting the appointment for the appraiser to come and inspect the home. The appraiser will call you to set a time that's convenient to inspect your home, and you'll be sent a link to pay for the appraisal via a credit card. If you're buying a home, your agent will be contacted to set the appointment. Once your appraisal is ordered, your loan file will then move on to the next stage, which is gathering and reviewing any missing documentation. You may work with the processor, who will be handling your loan file. The processor will review the documentation you've submitted to ensure that the file is complete. Processor's job is to be a liaison between you, the loan originator, and the underwriter who's assigned to the file. The processor looks for proper calculations to ensure the debt-to-income ratio, or DTI, on the loan is accurate and orders flood certifications, mortgage payoffs, and various other documents. The processor may communicate directly with you you and the loan originator to gather any additional necessary documentation for the loan file, which brings us to the next step, which is underwriting. Once a processor has received all documentation necessary to support the information in your loan file, they will submit the loan to the underwriter for approval. In most cases, after underwriting, an initial approval or a conditional approval will be issued. This means that the file is approved, but the approval is subject to certain conditions. The processor and the loan originator will work together to let you know if there's anything else they need from you. Time is of the utmost importance, so if the processor or the loan originator contact you for additional information, you want to be sure to respond to them in a timely manner so that your loan file keeps moving along. It's the underwriter's responsibility to ensure that every loan meets the lender's and investors' required guidelines. The underwriter will review the validity of the appraised value, calculate the income used for the loan, and run various loan fraud checks. If questions arise during this review, the underwriter will request follow-up documentation. It's the loan originator's responsibility to work with the processor to gather any requested information from you to satisfy the conditions that the underwriter has requested. In a purchase transaction, many moving parts must come together at the same time for the file to proceed to a smooth close. Sellers, buyers, real estate agents, and title companies or attorneys all have tasks and responsibilities that must be coordinated. So it's very important for the loan originator to remain in close contact with all involved parties and to make sure that everyone is aware of any potential pitfalls or delays that may arise. The loan originator will stay in contact with you during the transaction, and communication is critical for a successful transaction. So let's move on to step 9, which is closing. Once the file has been given the clear to close by the underwriting department, it moves to the closing department. In a refinance transaction, closing is scheduled at the convenience of you, the borrower, and the loan originator will inform the title company and the closing department of the requested time and date. It is best to schedule a closing at least 24 hours after the clear to close has been given to ensure that you have enough time to be comfortable with the figures in your closing disclosure. In a purchase transaction, the closing date is negotiated between the buyer and the seller of the property, and that date is included in the sales contract. It is the responsibility of the loan originator to ensure that the file is cleared in time to meet the closing date. When the file arrives in the closing department, the closer validates the information contained in the loan origination system. This information will include your rate lock, your fees, and your initial escrow amount. The closer will also run various loan compliance tests to ensure that high cost thresholds have not been exceeded. Once closing instructions are prepared, the closer will ask the loan originator to approve the loan fees prior to sending you your final documents and the final documents to the title company. Once the title company receives instructions from the closer, they prepare the closing disclosure and contact you, the borrower, to confirm the closing date and time. The closer then verifies the accuracy of the closing disclosure and forwards it to the loan originator for review. The closing disclosure must be received and acknowledged by you, the borrower, at least 3 business days prior to closing. This is typically when you sign your closing documents. So now you've signed your closing documents, and let's move on to the next step, which is what happens after closing. When loan documents have been signed by you, the borrower, and the 3-day rescission period has passed, this is for a primary residence for refinance, then loan funds are dispersed. Prior to funding, the lender will review the signed documents and ensure that any prior to funding conditions have been cleared on the loan file. Most lenders require the signed package back from the title company 24 hours in advance of the funding. This will allow plenty of time for the funding department to validate the documents, correct any errors, and schedule the funding date. So as you can see, there are many steps that go into closing a loan. You always want to make sure and ask your loan originator any questions that you have along the way. Stay in close contact and make sure that you know what the next step is.
Thanks for watching. If you have any questions or would like to learn more about the mortgage process, please contact me at the information provided below.